Welcome to our lesson today. As usual, we are going to begin with a brief review or quick review of the disclaimer. Please take a couple of moments to read it. Alright, in our lesson today, we are going to be talking about auction market opportunities. As important as the auction market is, it is one of the areas that is least understood by individual participants in the market. And yet the auction process itself and the auction market, once one is able to understand and follow the action in the market, can in fact capture a number of potential good opportunities. Now, typically a lot of traders don't engage and don't spend the time to learn about the auction because they are interested in just simply day trading. And honestly, even though the principles do apply in day trading, quite often they are very difficult to detect in very short time frames. We will be looking at some of the rules that apply in the auction market in our lesson today, and we will be looking at how the auction market can give us opportunities that cannot be seen or found anywhere else without the profile. You will begin to actually appreciate how useful the profile can be and how some of the professional traders use the profile in gaining a more in-depth understanding of the auction and when to participate in the auction. The auction has a number of different rules. We will review some of them in this lesson. The first and most important rule is really the idea that there are a multitude of different auctions taking place in the market at the same time. And I often like the example of the Russian dolls, the Matryoshka dolls, or if you speak Russian, I guess it's the mother dolls, to use that example to demonstrate how there are many different participants and many different auctions going on at the same time. And just as we see with these Russian dolls, one fits right inside the other. You can sort of take a look at the tiny little doll. It goes inside the one that's a little bit larger, and then both of these two fit in that one, and then these three will fit in this one, and all of them eventually will fit in the biggest mother doll. Now, to take this one step further and begin to actually implement the concept in the market, this is akin to the smallest and the fastest trader is a scalper. And really the market has changed a lot in recent years, and scalping is not what it used to be 20 years ago. Those the inefficiencies that were once in the market are rarely seen in action anymore, and so really the number of scalpers has been reduced significantly, but you still see high frequency traders scalping. Now, right after the scalpers, we have what we call daytime traders. Daytime traders are traders that participate for the duration of the day session. In the US, if they are in Europe, it'll be the European session. But they are daytime traders. And these traders are unlike scalpers in that they may hold their position for several hours or an hour. Certainly the intent is not to make a fast hit and run in and out of the market with a tick or two. It usually they would like to get a few points, two or three, possibly more during the day, depending on the type of day, and they behave a little bit differently from the scalpers. Then, of course, we have weekly traders and we have monthly traders. The weekly traders, really, their span of time is from 1 week to the next. And it could also be, a weekly trader could be trading based on days, 2 or 3 days, 4 or 5 days. But, the 4 or 5 days could technically be they put in a position on a Thursday and they didn't really take out their profits until the following Tuesday or Wednesday. So now they are in a different week, and that's why I lump them in with the weekly traders. It's not necessarily that they're only trading based on the entire week and waiting for the week to conclude to make a decision, but their trades could span from 1 week to the next. The next are monthly traders, and monthly traders now take on an even longer perspective of the market, and their trades could last for several weeks or possibly even several months. But their time frame is longer, and usually it involves larger sums of money. As a matter of fact, once we begin talking about the weekly and the monthly traders, we are talking about usually larger amounts, bigger positions, and a different type of trader, the type of trader that actually has the wherewithal and the ability to influence the market. Now, last but not least, we also have what we call the long-term trader, and there are many traders who represent clients. They have their pension funds, and they're looking to be in the market for years. So they may be in and out depending on what is going on, but for the most part, they are really there for a long time in the market. Out of the whole group, these two are the most volatile, and really as a result of the speed of the movement and the short duration of their activity, in many ways it is the hardest, or there is the least amount of tolerance for making errors in the auction. In other words, you really need to be buying at the right price and getting out at the right moment in time, simply because time is not on your side. If you're forced into liquidating a position or making a decision by the end of the day, that is a forcing pressure that certainly does not exist for the other traders that are in the market based on weekly, monthly, or long term. By the same token, the scalper and the daytime trader, if they can work in harmony with some of the longer term traders and can understand what they're doing, that will immensely help their own trading activity. Let me back up the slide here. All right. Let us review the basic concept behind market activity and behavior in the market. An auction, or the financial auction, is constantly rotating between buyers and sellers using bid and ask prices. And that's why it's constantly fluctuating, moving up and down, up and down, up and down. It almost seems as if the intent is to confuse the buyer and the seller and make sure that no one really understands where the market is going. But in reality, that is the function of the auction in searching for fair value, if you will, or searching for the areas where there are the greatest aggregate of buyers and the greatest aggregate of seller. Well, as the market pursues this search, what happens when it finds what it's looking for? So if it is the market is searching for buyers, what happens is in its search it will always look for the opposite of what it finds. So once it finds an aggregate of buyers and buyers dominate, the auction actually continues to move higher now in search of sellers. We have buyers, so we want sellers to create the effective market dynamic. Now, once the market continues to move higher, at some point it'll be high enough to attract sellers. Sellers will come into the market, and then prices start to drop. As the aggregate of sellers increases and sellers begin to dominate the market, prices now need to drop to look for the opposite of what we have, which are the buyers, and therefore we see when new selling and heavy selling comes in, the market searching now for buyers, and prices start to drop. The best way to really see this is to look at some charts together, and more importantly, we want to be able to identify where the auction is, the parameters for the auction, and whether the auction is looking for buyers or if the auction is looking for sellers. All right. So we go to our great profile charts to help us capture and identify these magnificent auction opportunities. And once again, this material is somewhat advanced and few people really are familiar with it, and the reason is there aren't that many people that know how to read the auction through the profile charts, and that's why I encourage you to watch this lesson a couple of times to gain the insights that I'm going to share with you, and to be able to detect them quickly when they do happen. Although here you will have the opportunity for time. In these examples, time will actually be on your side. So let's take a look here at, let me go back here. Let's take a look here at this specific week. And let's forget about everything that's going to happen. We are only going to look backwards, where we are going to compare between this week that I have highlighted for you and the prior week. Now, why do we select this this week specifically? And the reason is we have a number of things that have happened during the auction for this week that make it worthy of our attention. The first two things that have happened that are significant is we had an explosive range. What do we mean by an explosive range? Notice the prior week we had, let me get my highlighter here. Okay, we had a high here and a low here for the week on the profile, and then take a look at what happened the following week. We took out the low of that week, but not only did we take out the low, we also took out the high of the prior week. So this is what I describe as an explosive range. All of a sudden, this explosive range is telling us, pay attention here. The auction is not functioning in the normal fashion that it would. In a normal auction, if the trend is continuing that is in place, what we find, of course, is the definition of a trend, and that is higher highs, higher lows. So we should not have expected a lower low and a higher high to occur at the same time. By virtue of this occurrence, it is worthy of our attention, and it begins to flag for us there are opportunities to be had here. Now, we also notice that the value area expands higher. Now, traditionally, once we see expansion of value to the upside, we get bullish and we anticipate the market to continue moving higher. However, with an explosive range, that is actually a sign for extreme caution. The market itself, the auction process, is telling you, be careful. Change may be coming here. Now, many individuals will basically look at this profile and they don't have a good understanding of auction markets and how they function, and will say, wow, the market continued to move higher. The market is already on a very strong bullish track, and develop a long bias out of this explosive range and the move of value area higher. On the other hand, as we begin to take a closer look at this explosive range auction, as a seasoned profile reader, you are going to begin to see a number of other important observations that should lead you not to make such a hasty decision. Let's take a look at what the market is telling us and showing us through the auction. First of all, we have a very big underdeveloped zone right here in the auction, and this is an incredibly important development. This development, again, to the unseasoned profile trader, appears as an incredibly bullish move, and it really is, because the only way we could have had such an underdeveloped zone in the auction is if in fact strong buyers stepped in and significantly pushed the market higher. This is akin to when you attend an actual auction and the auctioneer is announcing prices, and let's say he is offering or asking $1,000 for the item, and someone else says $1,100, and we're moving up in $100 increments, and then all of a sudden somebody steps in and says $3,000. So that underdeveloped zone is akin to that activity in the market. So certainly it is a very bullish occurrence, and this also leads quite often to individuals making such a hasty bias about potential direction in the market. Now, I say hasty because it still has not been validated. The explosive range is telling us to look closely and monitor this particular auction, because the auction has things that are unusual occurrences for an auction. There are things out of the ordinary, and anytime there are things out of the ordinary, there are opportunities in the market. So that underdeveloped area is very important for me, and I'm going to show you how we will use it and how it will help us to identify potential opportunities. But not yet. There's more to be observed in this auction, and so let's take a closer look at what's happening here. We also have a single print, and usually when we have a single print, as we do right here, again, that is another example of a rapid and a very strong moving market that it just basically spent very little time during the whole week at this point. This point was just so bullish that we never came even to look back at it, and prices just skyrocketed from there, which they did. Take a look from the time that we hit this price level. Look at where the market, how high it went, and where it closed, without really revisiting that specific point. So that single print is a very important marker on the auction, and we will use that to our advantage. Now, what else do we observe and see on this auction? If you take a look, well, the single print I've identified here at 1982.75, and the reason we have identified it is, of course, because we will be using it in our analysis, and you'll see how helpful it will be for us. Next, the item that I want to highlight for you is the failed high. Take a look at what happened at the top of the range. Here, let me focus on it and show you. Notice how we've come to the high and we've tested the high twice, and both times we failed. So that now tells me a high that's been tested twice, the probability of a third test is there, but if it's not tested a third time, then that will be considered a high that was tested twice and failed twice. That is not a very strong high. That is in fact a weak high. Now that the high has failed for this week, even though, look at the explosive nature and how far the range expanded up above, yet at that high it failed twice in the auction. All very important, very significant observations. Now, the key is to take these observations and now begin to trade upon them. Mind you now, we have not seen anything from the next week. We're not, this isn't a process where I show you things after the fact. This is a process where we actually are projecting and this is the power of this process. We are really in harmony with the market, and we are looking at what the expectations are going to be for the following week, and we will have, as you will see, a very clear reading of what is likely to happen, which will help us to stay consistently on the right side of the market. So what are my expectations for the week? Well, before we actually look at the chart for the week, let's take a moment and discuss together what the expectations are. We know from the rule that we discussed earlier that when a market finds sellers, it is going to go and hunt and search for the opposite, which is buyers. So now it will begin to look for buyers. If we use this rule, we know from a failed high, twice failed high, that the market dropped and ended up closing here. So obviously, the market is telling us that we had sellers up here. If there weren't sellers up here, we wouldn't have ended up closing down here. We would have closed higher, because if these were buyers, the market would have shot even higher up. Now, we know that there are sellers up here, and we know that there are buyers up here, and we closed here. So there are really two potential outcomes for the following week. One potential outcome is the fact that the market may in fact come back up for a retest of the high. That is going to require new buyers and a push up again, and conceivably we could get another high. That is a distinct possibility. Now, so let's call that option A. All right. So we could go back up for a retest of the high, of the week's high. What else could happen? Well, we could also we could have experienced significant selling, and that is what caused us to close down here well below the failed high. And so now, as a result of the heavy selling pressure, we are looking for buyers, we are searching for buyers, and so we are going to move back lower to where we know these buyers were. And so the target would be our 1982.75 option, or come back to double check and see the commitment of those buyers, and if those buyers are still there. And if they are there and we in fact get a bounce back up, then surely we should now auction between the close and this point, and if we're able to surpass that, then we can come back up and retest that high for a third time, and we may succeed, we may not, but that's how the auction would flow. We come back up to the point where we know there were heavy sellers, that was way up here. So right now here at the close, we're not sure. It's a mix of buyers and sellers, but we're not really sure which is dominant. What we do know for a fact is at the high that failed twice, we have sellers, and what we know here is we have strong buying pressure, and they are clearly visible for us on our auction, on the profile. Now, these types of observations you are not going to see on any other type of chart. You simply just will not see them. So this gives you an appreciation for the sophistication and the power of the profile once read accurately and once read correctly. Professionals know how to read it. Professionals understand the auction, and this is why or this is how the professionals will trade. They will react to what they see in the market. They will begin with an analysis, and then let me show you how they begin to react to it in the actual market. All right, so we know the story. We closed the week right here last week at 2003. All right, and we knew our two options. It was one of two things. The market was option A, going to move back higher for a retest of the high if there were buyers in this area around the close, and if in fact we didn't have buyers and we had sellers, we were going to come back and search for the buyers lower. So the new week, the following week, opens a little bit lower, meaning it gaps down. And what happens in the next 30 minutes? It goes right back up for a test of the close. Then we have a number of 30-minute periods, to be exact, about 3. And let's take a look together at what starts to happen. All right. Here's the close from the prior week, and this is the auction range that we anticipated for option B. This first area down here is really the drop down to, actually the range should be a little bit lower, it should be right to about here, to the 1982 figure. So this is the expectation of the range if we drop. If we start heading up, the expectation would have been to the upside. So what does the market begin to do once we open? Well, it comes back up to the close and then begins to drop back down. Given our analysis and what we know, does that look like we're going back up for a retest, or does it look like now we're going to auction between the close and the last point where we found buyers, which was really down here? And this basically would be the new auction range that we would look at. So let's take a look at how we would trade that knowledge. Once we try to test the close and we fail, a reasonable entry would be a short at this point right here. We're coming down, we're dropping below the open, and so the range is now extending lower, and the entry lower would be around, the short would be around the 2000 level. Now, it is easy enough to identify our stop right at the close, so not terrible exposure here at the 2003 level, and our target is the 1982.75, all based on the auction. This is where we knew the buyers would be, and I would anticipate that we would go back to look for these buyers. Now, notice what happens as the market auctions lower. It doesn't go down in a straight line, so it tells me that there is selling pressure, but it is not very strong selling pressure. So take a look at the rotations. One strong rotation down, and then we have a retrace back up, and not even a straight retrace. It sort of pauses several times, and then comes right up to here, which was a value area high from, or a value area level from a prior week, and then it starts lower. But most important of all, I am concerned about the close. How close does it come to the close? And it doesn't even come close. And then what happens? We drop down significantly lower. Now, this is strong selling again. This looks like weak buying, strong selling. Strong selling. So we are auctioning lower. We come down to here, and at this level we start to falter a little bit. And notice what happens, and this happens very, very frequently. Many people have observed and know the actual target that we're looking at, which is the 1982.75 level. So the market comes very close to it, but never actually touches it, and then pushes back up. giving everyone the illusion that we are going to move higher from here. And yet notice what happens. We come right back to it. A second test, and then it pushes back up again from it. Again, reaffirming to all of those who keep taking longs at this point that the buyers are still here and that we're going to continue higher. Conceivably, this would have held. But for this to have held, we should have gone back up at least to break this prior low that we had made, which we never did. So we continue to move lower, and this time we pierce right through it. Third time's always the charm, and we drop again. But the market hesitates and comes right back to it again. Look, guys, see this 1982.75 level is a very important level. It's a line in the sand. The buyers had made a very strong statement at this level, and everybody is sort of doesn't want to believe that these buyers are not here anymore. So a lot of these buyers now are getting trapped because, again, they have committed to this idea. There was strong buying here. We are heading back up, and if I didn't grab it here, well, I'm going to grab it here. In any event, that really does not matter to us at all. We knew from the get-go that the market was going to auction lower if in fact it didn't decide to auction higher for a retest of the high. So once we see the break to the downside at the open, we should have been confident in knowing that we are going to go back for a retest of where the buyers were. And in doing so, we had a pretty clear idea about where the target was. Our stop was a fairly safe stop. This would have been a nice trade at 2,000 down to 83, 83 and a half, 84 even. A nice crisp 8-point trade or so, simply based on the auction and what the auction was telling us, and reasonably low risk. As far as between our entry of 2000 and 2003, that's a 3-point risk. Now, anytime we are going to be looking at longer time frame trades or weekly trades, the risk is going to the risk parameter is going to be a little bit higher, but at the same time it will be safer, and the likelihood of it actually getting pierced through is going to reduce. All right, so let's continue on and take a look at the next buyer zone. So we know that there were buyers up here. Well, what happens if these buyers don't manage to push things back up in the market, and in fact they've vanished, or for whatever reason they've changed their mind about the market, and now the market is going to drop lower? Where is my next area of buyers? Again, from the preceding profile. Well, take a look. We've got a ledge here, and we have a close from the prior week. We have buyers at the 1976 zone. This was the area from which we shot up at the beginning, or at the bottom of this underdeveloped zone. So obviously this was all buying pressure that led to the move higher. We had a distribution here, and then we sped through this area for a new distribution up there. And so now we are looking at, and I call it the 1976 zone because I hate to use exact, precise price levels. The market doesn't work that way, especially now that we're looking at weekly or a few days trade. We have to have a little bit more tolerance, and so we have to begin thinking of a zone, and around 1976 could be as much as a point above it or a point below it. That's the range of the zone around that that level. So let's see now if in fact once the market decides to drop, and take a look at how well it holds at this particular zone. So here's our 82, the line in red, that famous line in the sand. We had quite a bit of activity around it. We tried once, we tried twice, we tried 3 times, we tried actually 4 times to make it above it. Now, knowing what we know, each of those failures would have been a good short-term opportunity. So even if I didn't want to take a long-term perspective to the trade and I wanted to trade on this analysis intraday, that would have been helpful as well. So now we're looking at between 82 and down to the 76 zone as the next auction range. We know when this fails that in fact then this becomes a zone of sellers, and here are the buyers. A smaller auction range, but take a look at what happens. We come right down to it, pierce right through it, and then what happens? Buyers begin to step in. Now, the question I have here is, how strong is the momentum to the downside? If you notice, now we're beginning to see the dynamics of a downtrend. Higher, a high there, a low that is lower than the prior low, a lower high than that one, another equal high here, or maybe just a tad higher, but we have a lower low, lower high, lower low, and we continue lower. And we pierce through that 76 zone where we anticipated to find some buyers, but we drop down here to the low of the prior week. Notice that's where we are here, and that holds us and we get some buying momentum. However, this is really indicative of strong momentum to the downside. The auction is not revealing, watch this, see 3 big bars down. Again, big bars down, very short, narrow, small bars to the upside with a lot of faltering. The buyers are having trouble. The sellers are having a field day. Come on, buyers, buy all you want. We're going to sell to you. There is strong selling pressure. So look at how many 30-minute periods it took just to overcome these last 3 bars. That tells me momentum is still to the downside. Let's continue on and watch what is happening with our with the market. All right. Commitment of buyers at this point in time based on the momentum we see and the fact that when we hit that 76 level it dropped even lower and lower. The buyers are not really committed at this point in time. The buyers are not interested at these levels anymore for whatever reason. Changes happen in the market, and this is why there is never any certainty as to the outcomes. We have to continue looking at the chart and analyze. So let's take a look. Buyers, how committed are they? Well, they're trying, but we really don't see any initiative, strong buying like the strong selling that we see. All this, we are merely analyzing activity, and now we have brought it down to the 30-minute chart for the entire week. This, of course, is the weekly profile as it develops. So we're not looking at things after the fact, we're looking at them as they develop. Here's the first stand for the buyers below the 82 level. Now take a look, they don't give up. They're still trying. Here's a second stand. And we have a new day that opens up in the week. And they make a third stand on that new day. All along now, based on our observation of the auction, we know that we are auctioning lower and that the market is in search of buyers. At this point, we found some buyers, but it does not look like strong initiative buying activity. It looks like responsive buying. So let's continue on and study the auction. Now, I've had to move the chart to the following days because we're really tracking the move over a number of days, but This was the last point that we looked at. This is what we called their third stand, and the buyers are fighting to hold. And so here's what happens. They come back up to this level, still struggling, and then a buyer apparently looks at the progress that the market has made and decides to plop down enough buying or enough buying activity, buying enough shares that look now initiative buying. And it pushes the prices back up. And guess where it takes it back up to? Back to our famous 1982 level, right back up here. This was the level where we sold off from. What happens? Well, sellers are still there. Notice now we're auctioning between where the buyers drew their line in the sand, and then we auction higher to the 82 level, and then we continue a little bit more, but we never make it to the close. So now what the market has done is it has pulled in longs again, thinking that's it, this is the buyer's stand and we're going to continue higher. But take a look at what happens. We come back down, and here's my 82 line, and we pierce right through it again the second time. This time, take a look at the force of selling activity. And on this second retest, the sellers really now begin to dominate the auction. Just visually look at the difference between what you see here as a buyer and what you see here as a seller. Now, you will have seen this as the buyer, and so you should have known that we are weak as we auction upwards. So now be prepared for your short. And this will be a very nice short, because this indicates, if in fact this happens, there's initiative selling here, and that is the beginning of a strong move or a strong auction lower in the market. So notice here the 82.75 level again. It comes right up to it. It appears to hold as support and moves higher. All right, we have a lot of longs now that think we've made it. The 82.75 has now held, and we've trapped a lot of longs. When we come down here, notice how all these longs are struggling and at all the stops that will get hit down here. And this is why this is the longest bar of all of them, because all of these longs are now trapped, and when they see that prices drop back again, opposite of what they expected, the initiative selling comes in here. They begin to cover. When you have longs and you want to get out, you're going to be selling. They actually now add more fuel to the fire and push the market lower, and all their stops get taken out. So knowing what we know from our analysis, we should have been ready to go for a short-term trade. And when I say short-term, a weekly trade. And the way that we would have identified this is really basically by continuing to monitor the flow of the auction and knowing these key levels from basically studying the prior week's auction. There's really no mystery to it, just an understanding of the auction process. Now, notice the beauty of these short-term auction-based trades. Let's take a look at how we structure them. I should be, and again, not to get carried away. Yes, we had buyers come in here. When this happens and we break through the 82.75 level that we had, where we knew we had buyers before, we thought we had buyers again here. It doesn't hold anymore. Even after the second time up, there's initiative selling. I should be prepared to take a short right in here somewhere. And as a reasonable point, I 2 points below, almost 3, 1980. So I'll just say I got in at the 1980 level. And this time I'm anticipating, because of this initiative selling, and because I know that the auction now, the sellers are in control, and we're going to have to auction lower. The buyers just have not been able to hold, and we now need to be looking for a new level of buying. So there's my entry. I'm planning on holding on to it for a while, as in several days. Then it behooves me to make sure that I have a good risk management strategy, and right here I would place my stop at 91. Now, I mentioned to you earlier that in fact your stops are going to be much wider. Those of you who are used to intraday or scalping or these other techniques, these may sound like a very wide stops for you, but again, as you continue to monitor the trade, there is security, because this level has failed twice up here. You are working in tandem with the auction, flowing with market activity. So you have to have risk management in place, and you have to give the trade some room to breathe and to maneuver. So anyway, we're short here. There's our stop. And again, we pick the stop based on the last high, which was right up here. Conceivably, you could choose this high as well, but depending if it's a point or so difference, not a big deal. So we continue on to monitor the development of the auction. Now, never expect the auction to go straight down or straight up. As usual, we're auctioning down. We need to auction back up again. We found sellers here. As soon as we find buyers, we want to come back up and test, are the sellers still there? And if you follow the market that way, you are moving with the auction ranges as the market auctions between buyers and sellers. So obviously, sellers up here, okay? Market drops. Then we've got buyers down here in the auction. Notice what happens. We get some buyers. Then we come back up. How far up do we make it? Do we make it up back to our 1982, the magic line in the sand? We do not. So what happens? We see that the market falters right at this level and drops lower. It is time for me now to move my stop lower to 1980 once prices start to drop again. So now I have some, hopefully a little bit of profit in the trade. It's come down to the 1975 level. When it comes down here, that's when I put my stop up here. I bring my stop lower. So I manage the trade and reduce my risk. So I'm at the 1980 level for my stop, which is basically the level I entered at, a much better risk picture. So market continues to move lower, all right, and we create a new low at this point. And at this point, we're now below the 1960 level, so we're down here somewhere at 55 or so. Well, am I satisfied? Do I see enough initiative buying to get out of the trade? Well, let's see. We did get some strong buyers up here, but they brought us all the way up to this level. Notice it takes patience, and to capture these moves, you really have to stay in tune with the auction. So we auctioned up here, and we found sellers here again. We dropped back down here to a lower level than what we had. There were buyers that brought us up here, and the buyers brought us up. But notice, this time they brought us up to a lower high. So on this second try, the buyers are still weak and not pushing higher. So, and besides, I'm now at a break-even trade. Notice what happens. It comes right back up to the 1980 level that I had before, but never quite hits that 80. Precariously close. That's the auction process, coming down, coming right back up to where there were sellers. So buyers made a stand here. They brought us back up to this point. Now, look at the activity of the day. This is all intraday type of trading. There's no commitment here, with the exception of some initiative buying here that didn't really hold. and dropped back. The buyers tried to recover, and then they continued to struggle all the way up. Now, notice at how definitive the selling is. Strong, big bars. Buyers come back in. Strong, big bars. The seller is still definitely in control. We try to make another high. Smaller bars look big green, big red bars to the green ones, and we continue lower. Quite often, this is how the market will shake the shorts. The market knew that there are sellers here. There's aggressive selling. We are in a bullish market. Look at how resistant the bulls are. Everybody is still buying, still buying. And so this is really a very strong seller and strong selling pressure coming into the market. Let's take a look at how we continue. We tested up here this level once. We've come back again for a second test, and the second test fails. We come back up for a second test, and the first test fails, the second test now, and the second test also fails. So just monitoring this auction activity, the first test fails, second test fails. At this point, even if you had not gotten into a short yet, you should really be thinking about one. And let's take a look at, since we are in a short and we got it way up here at 1980, and we see this dynamic in the market, I'm saying at this point, if you are a strong trader, you may consider adding to your position. Strong meaning well capitalized. You may consider adding to the position, and then take a look. You'd add to it somewhere here because you've watched that the sellers are really now in control. Now notice you're looking at the market from a weekly context. You're not subject to all these. I mean, you come in periodically to look at it, and you analyze on much larger time frames, so you're not subject to the pressures of the scalpers and the daytime frame traders. You've got a lot of latitude here. Many opportunities where you could have taken a profit already on that 1980 position. Now take a look at what happens after this second fail. Prices continue to drop lower. Here's where we were looking around the 1960 level. So even if you began taking a short here, take a look, market continues to drop and drops all the way down to 1920. At this point in time, though, I begin to see signs of initiative buying, and the market has come down significantly, meaning we're down all the way about from the high all the way down to 1920. That's a significant move down. That is when I should begin about thinking to take my profits. I could enter the market again, but let's say we decide that we want to exit at the 1940 level. So once we see some initiative buying here, look at this strong wick here that was picked up with several strong bars behind it. This is a strong buyer here. So when I see that, I decide I want out at this level. I'm not going to tell you you are going to exit at the peak or at the best price possible. 20 point between 1940 and the lowest low that we see on the chart, 20 points. That's the nice thing about long-term trading. You have a little bit of latitude. You have 40 points in the trade, give or take, at what point you decide to take out. So it's a nice trade. It's been 2 or 3 days, but this is a potential danger sign. Time to take profits. The auction is going to begin to rotate higher because of some initiative buying here. Are we going to see a reversal, or are we going to continue lower? I am content with what I have in the trade now. You don't want to get too greedy, and take profits whenever you can. We can always go back in again if we go up to a level for a retest and it fails. For instance, we saw that 1967 or 68 level had provided resistance before, and this was the last line in the sand. Well, how will the market react when we come back to it? If in fact it fails, I could take another short position again. So let's continue on and follow this train of thought. We're still all within the following week. That's still just the next week. We haven't gone beyond a week. So let's take a look, and we come back to the 1968-25 zone here, and let's see what happens. We break down and prices drop from it. So if you want, now we're beginning a new week. Once you see this new profile, that is a new week, and it looks like this week opened towards this level of the prior week, and then prices are dropping again. So the 68.25 did not hold, but notice now how the gap of auctioning between buyers and sellers is beginning to diminish a little bit. In other words, this is when I begin to see some buyers and then selling again. So now I need to know, will this support level hold or not? Let's continue on to take another look. It does not hold. The move continues lower. There is still selling pressure in the market, and I have opportunity to sell. The market is auctioning lower. The move continues lower through the following week. But notice we did go back up. See the auction process back up to the 1968 level when and look at this strong initiative buying that we see here. This is strong initiative buying. Now it comes back up to here for another try, and then I do get selling, but notice how what we were seeing in the buying before is now happening in the selling. Look at how many 30-minute periods it takes to overcome these three powerful bars back here. Now momentum is starting to shift. First sign of initiative buying. I begin now to change my bias and to begin carefully looking to see and study this initiative buyer. How strong are they, and will they be able to overtake the sellers? This is the first significant sign for me. Things are changing in the market, all based on observations in the auction. So once I begin to see the buyers overtaking the sellers, and I begin to see some higher lows and higher highs, my bias will change, and I begin to now recognize that the auction is going to look for the opposite of what it was looking for in the past. Since we had sellers, it continued on to look for buyers, and it looks like it's finding them at these levels. And once it finds buyers, we began our lesson by stating a very important rule, and that is we will look for the market will begin to look for the opposite of what it finds. So it will take prices again higher to see where we find sellers. So the auction continues to rotate back and forth between buyers and sellers, and people will look at this and use different terms to really describe the same things that we are observing about the auction. I am sure you have heard the terms support and resistance. Well, where does the support come from? Where does resistance come from? Resistance really means the presence of sellers. When you begin to use the vocabulary that is consistent with the auction and an understanding of auction market principles, it is easier for you to see what is happening in the auction. You begin to see the rotations. You begin to see first tests, second tests. The profile helps you to identify in advance these lines in the sand. It exposes for you valuable opportunities. Yes, the opportunities may take a little bit longer if we're looking at a weekly time frame for them to come to fruition, but keep in mind that the traders that have the ability to influence the market typically are working on the larger time frames. And if you can manage to keep your activity in harmony with what they are doing, you are going to be on the right side of the market more often than not, and you will definitely increase the probability and the likelihood of success with your trades. That is why it is very important to, one, understand the auction process, and two, to be able to read, is the auction moving now between sellers and buyers or buyers and sellers, and three, which of them has been the most dominant in this particular auctioning range. Now, it takes a little bit of time to acquire that skill. I encourage you to watch the lesson a couple of times and then begin to practice reading it week to week. With practice, you will certainly get better, and you will see the improvements. With that, I will conclude our lesson.